Welcome back to the channel. My name's Brahim and we're going to be looking at Deliveroo today. So for anyone that's not from the UK or you've never heard of Deliveroo before, basically Deliveroo is one of the most popular food ordering services in the UK. In other places you might have Uber Eats, which you've heard of. Deliveroo competes against Uber Eats and Just Eat, which is basically now called Hungry House because it did a merger with another company. So Hungry House, Uber Eats, Deliveroo. That's the main three that will deliver you takeaway food basically. But Deliveroo is planning to IPO very soon. They have filed interest for going for IPO with the LSE, London Stock Exchange. Deliveroo reveals narrowing losses ahead of IPO. Food delivery company posts £224 million in losses despite a 54% revenue growth during the pandemic. Now, 224 million in losses, but yet their revenue went up 54%. Deliveroo has unveiled plans for its London stock market debut as it revealed a 54% growth in sales but losses in 224 million in 2020. The Amazon-backed online food ordering company announced its intentions to float on the London exchange market on Monday, suggesting that its shares are likely to begin trading by early April. If you wanna buy an IPO, that's down to you. But I personally am not going to touch on IPO. I might look into it, but I'm not going to buy an IPO. That's for facts. Also, Amazon does own it. You know how Amazon likes, basically it's a monopoly. They like being in the streaming industry, they like being in the consumer staples industry. They got their own grocery stores now, one just opened in the UK recently. Anyway, the filing includes details of a dual-class share structure that will give Will Shu, Deliveroo's co-founder and chief executive, 20 votes a share, while every other shareholder will have a single vote for each share. The structure will expire 3 years after the listing. Now, I've never heard that. This is new to me. 20 votes a share. If you want the same amount of votes, you're going to have 20 times your shares, basically. What we want is the ability to provide stability in the management team to focus and execute on our long-term vision, said Shu, explaining the Silicon Valley style control structure avoids being driven by short-term interests after it goes public. London's based Deliveroo has privately targeted a valuation of as much as $10 billion or £7.2 billion. People briefly on an internal discussion told the Financial Times last week. Monday's filing revealed that more than 6 million people from more than 115,000 restaurants and stores through Deliveroo every month. More than 6 million people order from Deliveroo every single month. Its gross transaction value, primarily made up of customer spending, rose 64% to $4.1 billion in 2020. Now remember, they still posted a loss of £224 million from 4.1 billion. Anyway, a delivery spokesperson said that the net revenues mostly consisted of fees charged to restaurants and consumers were 1.2 billion in 2020, up 54% on the previous year. That included net revenues growth of 65% to 599 million in the UK and Ireland last year, suggesting that Deliveroo outpaced its more established rivals Just Eat to gain share in its home market. Like I said, Just Eat, Deliveroo, and then you have Hungry House. Realistically, Deliveroo is on another level. You'll see loads of them with their blue bags and their bright blue jackets, cycling, or some of them motorbikes, but majority of them cycling, around London and other places in the UK and Ireland. Passing food from 115,000 different restaurants to 6 million people per month. Let those numbers sit in. The company said growth was driven by increased customers and more frequent usage. So people ordering more. That's good. That's good. As the coronavirus pandemic drove more people to try online deliveries for the first time, tapped into new audience. People have never ordered food online. Some people don't trust it because they don't know what's in their food. But because this pandemic has made people want to. Even when the lockdown rules that shuttered restaurants were lifted and the UK government incentivized people to eat out to help out, Deliveroo continued to grow rapidly and the order frequency of customers remained high, Shu said. So in the UK, if you're outside of the UK and you didn't know, we went into 3 lockdowns and we're currently still on the 3rd one. After the first one, Boris Johnson did an Eat Out to Help Out scheme. Eat Out to Help Out, simply put, was a discount for you when you go to your restaurant. I don't remember what it was. I think it was like a place. No, it was like 50% off up to £10. But in my workplace, we did 50% off everything. And I think the days was it Monday, Tuesday, or something like this. So every Monday and Tuesday throughout the whole of August, we would get 50% off on a Monday to Tuesday, which is supposed to be the quieter days in hospitality, which is true. So to drum up more business, 50% discount, more customers, more revenue, blah 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 blah. Anyway, so the fact people can leave their homes finally after being at home from March to July doing nothing, not having takeaways, and Deliveroo still managed to keep the high demand for takeaway delivery orders. That's amazing. Deliveroo narrowed its underlying losses from the previous year by 29% to 223 million in 2020. Still a bit confused considering it had 4.1 billion and it increased its revenues. After adjusting for various items, underlying losses before interest, tax, depreciation and amortization were 9.6 million last year, down from 231.6 million in 2019. It was profitable for 2 quarters of last year on the same basis, which excludes finance costs, stock options costs, and other one-off items. The company warned prospective investors that it would continue to prioritize expansion over profitability. So they're trying to get bigger before they become profitable. I mean, being bigger is good, but debt is not too good dependent if you can't control it. So be a bit cautious. They might be taking on a bit of too much debt, might not have that good cash flow because they're still not making a profit. So saying it remains focused on investing in driving growth in its nascent online food market. Our ambitions have increased as we start to truly understand and execute on the opportunity in front of us in online food, said Shu. However, the fact that the 8-year-old company did not come close to overall profitability during a boom year for food delivery may raise questions from prospective investors about its long-term business model. I would have questions too, considering you're telling me a time when everyone's stuck at home, your orders were at the most out of your 8 year doing business, and you're still unprofitable. Little bit worried. It's good to see they're expanding, but like I said, debt could ultimately take them out. Go be careful. He described Deliveroo as a pure play food platform, encompassing the far larger potential market of groceries as well as restaurant dining. We think we are day one in that opportunity, he said, echoing Amazon founder Jeff Bezos, maximing that it is always day one at the e-commerce group, which was loss-making for many years. Now, if you look at Amazon was a company that started just selling books. It sells everything. That's why the little logo goes from A to Z, because they sell everything from A to Z. It really does sell everything. But Amazon really hasn't been looking into profitability only till the recent years. They was always looking at expansion and growth, and customers was key to them. Amazon, in my opinion, has the best customer satisfaction. Like, You have any issue, you'll get it resolved quickly. I've had issues with Amazon's and they got it resolved. I remembered calling them in a pandemic. Well, we're still in a pandemic, but in the worst time of the pandemic. 14 seconds to answer the phone. I think that deserves a clap. 14 seconds. Amazon was able to answer the phone. So they cared about their customers. Bear in mind, that was Amazon's way to grow. Expand, 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 and care about your customers, and that's what they've done. Now they're going to focus on profitability, which is good because look at the market cap it's a $1 trillion+ company. Profitability should matter at this point. If not, when will it matter? Anyway, looks like Deliveroo wants to follow the same steps of grow, diversify, care about customers. Monday's findings argue that its logistics technology will continue to improve efficiency and productivity for restaurants and its fleet of couriers, boosting its own profitability on each order. Existing customers typically increase the frequency with which they place orders. Delivery added, acting like a recurring revenue stream that grows over time. Goldman Sachs and JP Morgan, I don't know how to pronounce that name, apologies, are Deliveroo's joint global coordinators. Will you be investing in Deliveroo on IPO? Will you look more into the company? Well, I definitely say look more into the company, and if you're going to buy the IPO, that's down to you. Personally though, I feel Deliveroo has a long journey to profitability, a long journey. But it is one of the most dominant food delivery services in the UK, competing against Uber Eats and Hungry House, but realistically, Deliveroo is dominating. Just needs to become profitable and maybe fix on a few issues it has. If you like this video, please leave it a like, and if you're new to the channel, subscribe. I'm trying to get to 1,000 subscribers by the end of the year. That'll be absolutely amazing. What's your favourite thing you've ordered from Deliveroo? Put it in the comments down below. My personal thing, Wagamamas. Love it.